Hello, I'm Josh Pulatty, and we are in studio with Churchill, Texas.
I am Ryan Bernal, and today we have the pleasure of being joined by Mr. Randy Key. He's also a branch manager here in Dallas, also a producing loan officer. Randy, thank you for joining us. We're excited to have you here and excited to hear what you have to say about the process and tell us a little bit about who you are. So without further ado, tell us how you got into loans. Where did you start at and what did that journey look like?
Yeah, glad to be here with you guys today. So I don't know that anybody comes out of college thinking, or high school or wherever, thinking that I want to grow up and be a mortgage loan officer one day. So it's always interesting to hear the answers to that question, because I think it's always a unique journey to get into this business. But I went to TCU over in Fort Worth, Texas, and got out of college with an accounting and finance degree. Went into banking for a few years, kind of the credit analyst path. Wound up in doing commercial mortgage origination, so similar to residential, just commercial properties, and really enjoyed that. Did that for 4 or 5 years before getting over into residential. And what drove that decision was really just the 2008 subprime meltdown on the residential side, which caused a credit freeze on the commercial side. So up until then, we in the commercial real estate world hadn't been paying attention much to the residential problems because we thought that was a different side of the industry and wouldn't affect us. And boy, were we wrong. We had clients lined up that needed commercial loans, and we had nowhere to place them. So it was a unique time. And so had a friend that had just refinanced with Churchill at that time. And, part of the reason for Churchill, the industry getting busy, was that we ended up in a recession driven by the subprime bubble. So what started as a bad thing for residential ended as a refi boom. And so I kind of came in at that point, joined the existing team of Churchill back then in 2008, at the very end of 2008, early 2009, and thinking it'd be a temporary thing. And just really ended up enjoying it more. Commercial is very transactional, all about the numbers, and my finance brain liked that, but it just wasn't very much, or weren't many deep relationships happening. Right. It was more
didn't satisfy the soul.
Yeah.
So speaking of deep relationships, married, kids, tell us about your personal life.
Yeah, so right about that time, 2004. So I was in the banking world. In fact, I had just started and met my wife, Lindsay, at work at a Wells Fargo bank in a credit training program. And we were in a little small group of about 8 or 10 that were going through training together. And so we both really just kind of became friends, and we were in different offices, so we weren't ever sitting next to each other in the cube world. But we were doing the same role, spent a bunch of time together in training, and eventually noticed each other, and got married that year, the next year. So got married in 2004, so been married 17 years. And during that time, we've accumulated some children. We have 3 daughters. Morgan, Allie, and Kinley are their names. They're 12, almost 12, 10, and 8. And then we adopted a little boy about 2 years ago. He's 3 now. And so he's 5 years younger than the daughter. So he basically has the 3 daughters, my 3 daughters, and my wife, so four moms.
Oh, goodness. He keep you on the
He
toes.
is absolutely spoiled rotten. Yes, but he's a blessing. Been fun to have a boy for a change when you live in a house full of girls, learning a lot about boys that I didn't know. Potty training especially is a really good time.
I've heard that comes on a lot later. I'm like, I'm glad my first one's a girl. Maybe it'll be easier.
Yeah, it was quite a bit easier with girls. We were really, he's not potty trained yet, and he's 3.5. And I don't. He may be 6 before he's potty trained.
So what I want to talk about today is the overall home buying process, from the first time that if I am a homeowner or home buyer and I want to go out and buy my first house, or maybe it's not my first house, maybe I'm buying a second house, what that looks like from that first phone call when the idea first pops into my head all the way through my first payment. What I go through as the home buyer, what I'm handling, but also what you're doing on your end, because there is a lot of work that, us, the home buyer, doesn't necessarily see on the mortgage side of things. So, first phone call, I give you a call. Hey, Randy, I want to buy a house. What are we talking about? What are you walking me through? What does that conversation look like?
Well, the conversation differs a little bit, family to family. I like to always start with the educational side of the conversation and really just finding out about them as a family, what their needs are, what their budget is, really honing in on their specific circumstances, and then kind of just coaching them and educating them on the different programs available out there today. There's many different loan programs, and they're all a little different. Some are great for certain family or borrower. Others are not good for a certain type of client. So I think just finding out all their facts, all of what's important to them, it's kind of step one. That's where I usually would lead that conversation. And then from there, once we kind of have a little better understanding of budget and down payment amount, stuff like that, then we'll move in and I'll recommend a product, a program for them. And I like to explain that there are multiple programs and kind of talk briefly through each of them just so they know that I'm not steering them to one without explaining that there are others. But I'll generally always lead them to the one I feel is best and explain why that program is better suited for them and their needs than the others.
And, how long does that conversation generally take? First-time home buyer, you're talking to them, because I think if there's anything about this process, it just seems overwhelming at times. And so, how long does that take? And, do you like to keep it simple? Tell us what that looks like.
Yeah, I try to not use banker, slogans and jargon. I think I'll hear guys in our team in the office, on the phone sometimes using, terms that make total sense to us here, but the person on the phone is confused and lost. And I think a lot of the trust that we build with our families, our clients, is that they understand. And so if you leave them, you sound really smart using all these big mortgage terms, but at the end of the day, if they're confused, they may still go with you, but they're going to be on edge and really just confused and not comfortable. They won't have a peace,
Right.
about what's happening. So, I think that's real important, is to, spend, you said, how long does the first call take? I think is what you asked. I mean, typically 30 to 45 minutes is and we'll, most of my business comes from friend or family or referral partners I work with. And so we spend time kind of talking about that connection and just getting to know them personally. If they have kids, finding out about their family. If they are single, finding out about what they enjoy doing and, nights and weekends and hobbies. And so just kind of connecting with the client, I think is a great place to start. It kind of puts both of us at ease at that point. And then you can dive into, the fact-finding questions.
I actually have a really good question off of that because, working with realtors, primarily that's where business coming from for you. The relationship's really important. And especially with first-time home buyers, tough market, a lot of layered factors in buying a home right now. How important is it to have that kind of relationship with your realtor, lender, and buyer? What makes it easier? What makes the process easier when you have that kind of trust built?
Yeah. Good question. Well, buying a home is typically the largest financial transaction most families ever make. Yeah. Most the average adult human ever makes. And so I think assembling a strong team is super important. So that's part of what we'll talk about at the beginning is identifying, how they got to me. If it wasn't through a realtor, talking about, how important realtors are to the process. Oh, yeah. And if they don't know one or have a good one that they know and trust, then we obviously will refer one out based on where they're looking. And I think I kind of call it building a team, or I think of it as building a team. Mm-hmm. We want to assemble a trusted loan officer. Step one. Step two is a trusted real estate agent that we know that isn't a part-time agent that does it here and there and isn't really familiar with all the pitfalls and all the things that can go wrong. So having an experienced agent, super important. Right. And so, I think to best put their mind at ease is to have a team they know is on their side, that they trust, to counsel them and lead them through the process, and so that it's a successful mission and transaction at the end of it.
Right. And I mean, that kind of plays into, because I think a lot of what we see now, especially with things being so tough, is, where can I get a better rate, or where can I be cheaper elsewhere, or where can I, I'm not going to say cut a corner, but, you don't want to spend an arm and a leg kind of in this process. But at the same time, you have to trust that kind of quality. And would you say it's safe to say that, making sure you surround yourself with that team is going to make a difference when you're offering, when you're trying to get a contract accepted? Tell us a little bit about how that relationship affects the buyer in that process, like where it will make it easier to get offers accepted and or just make the process smoother on that side.
Yeah. So one of the original things I'll address with the customer is mortgage interest rates.
Right.
And I'll talk to them about how they move up and down and kind of what the primary drivers of movement are, and just kind of give them a real high level overview of mortgage interest rates. And because you don't want to not address rates, you don't want to go through the process and never talk about rates, because then they'll always be wondering, well, maybe does this guy have good rates or really high rates? So I like to address it, talk about it, and then move forward explaining that interest rate is very important. But it's one of 5 or 6 variables that are really important. And there's a lot of discount real estate companies out there now. You see them popping up all over the place, and a lot of discount lenders out there. Yeah. And so they're advertising to be cheaper to save you money. But if they're not representing you well, and if they're not helping you get a home under contract, which has been a challenge in the last couple of years, then it really doesn't matter what they're saving you in theory, because you're never going to get to the finish line to actually realize that savings. So I think that the ability and the process of getting a home under contract obviously starts with making an offer.
Mm-hmm.
And to back up a little bit is when we move on from that first conversation into the process, we do what we call a certified home buyer, which is a pre-approval, but that one that's fully underwritten.
Right.
Certified home buyer is just our branding around a fully underwritten pre-approval. So that doesn't mean much to the average homeowner, because they think, well, isn't that what all lenders do? Isn't that what a pre-approval means? So that's where we kind of explain the different levels or types. So you've heard the term pre-qualification and pre-approval. Those are kind of industry standard terms. And when my wife and I bought our first house, I didn't know the difference. I thought it was just an interchangeable word. That same word, different, or same meaning, 2 different ways to say it. But what I've realized, or what I now know, is that there are big differences in a pre-qualification, a pre-approval, and then the third level, which is the fully underwritten pre-approval, is what we call our certified buyers.
Right.
So pre-qualification just means that you've had a conversation. Everything is verbal at that point. You could say, I work at Apple and make $150,000 a year, and I've got 20% to put down. And that loan officer at the time will issue a pre-qualification letter based on all of that verbal information. So we generally tell our clients it's not worth the paper it's written on. No seller is going to entertain an offer if you've got a generic pre-qualification letter, from some kind of push-button internet mortgage company, right?
Right.
So, but that is the first step. You start with an application. You do everything verbally. That's how the process starts. But a lot of lenders will stop there.
Right.
Or they'll go to the next step, which is a pre-approval, which simply means that the client turns in the pay stubs, the bank statements, any other income or asset documents needed.
Right.
And then that loan officer, or more likely a junior person on the loan officer's team, will go in and enter the numbers exactly off those documents and kind of size it up themselves and say, yeah, this all looks like what he said. We're good to go. We're pre-approved.
Right.
The problem with that is the person reviewing that is not an underwriter. The loan officer assistant or the loan officer, whoever's doing it, is may have a lot of experience in the mortgage business, but they're not the one actually responsible for knowing all the underwriting guidelines and underwriting the loan.
Ultimately approving it.
Proving the loan.
Right.
Yeah. So most lenders, I mean, I would say 9 out of 10 stop at the pre-approval level because they don't want to use their underwriting resources because their underwriters are real human beings that have six-figure salary jobs. They're in high demand, and especially good ones. And so they don't want to use their resources on underwriting the loan until they have a contract on a house. So your loan stays in that pre-approval status from the moment you talk to the loan officer initially all the way till you find a contract.
Right.
And then for the very first time, whether it's been weeks or months that you've been working with that lender, once you have a contract, then it goes in underwriting for the first time.
Right.
And there's so many different things that a front-end team, a loan officer assistant can miss that the underwriter then picks up, and all of a sudden they become huge 11th hour fire drills, right? And maybe you still close, but it's one of those experiences where, hey, I thought we were pre-approved. You know, why are you asking for 10 more things, or why are you saying I don't qualify? You know, and that's hard to hear, especially if you've been house hunting, you've got earnest money, non-refundable earnest money at stake, and all of a sudden you find out the lender that told you were pre-approved now says you're not, or you have to put more down, or you have to get your credit score up. You know, there's just so many things.
Right.
So that's why the third level that what we've created called the certified home buyer is so valuable to our clients and to our realtor partners as well, because we'll actually go ahead and underwrite your loan right up front. What other lenders will wait to do when you get a contract, we do as soon as we have all the documents in and are able to submit it. So we get what's called a loan approval, notice of loan approval, and it has conditions. And conditions are things that requirements we have to meet prior to being able to fund the loan. Gotcha. And there's borrower-related conditions and there's property-related conditions. So obviously we can't clear property-related conditions until you have a contract because we don't know what house you're buying. But anything related to the family, the client, we clear all conditions if there are any immediately.
Very nice.
And that way we are able to call the listing agents when you're making an offer and say, hey, this isn't just a generic pre-qual or pre-approval. I know a lot of the lender letters look the same, so let me explain where we are. You know, we've got all their documentation in, income, assets, credit have all been verified, signed off on by the underwriter. There are no conditions left to fund this family's loan except property-related conditions. So that a lot of times will give our clients that leg up, particularly if it's a multiple offer situation. You know, that the listing agent will go back to the sellers and say, hey, we got a push button pre-qual letter, we got a pre-approval letter from a reputable company, but then we have this basically same as cash buyer over here that's already been through underwriting. All their conditions are cleared, and we can close them at 2 weeks at that point because all we need is an appraisal on the property, and we close, which we can get usually 5 to 7 business days. So we can close really fast if you're at that point. And those things added up will a lot of times sway that seller in our buyer's favor so that our offer gets accepted over the others.
And let me tell you, do you reach out to every listing when you got an offer going out? Do you reach out to the listing agent?
Absolutely, every
absolutely.
Time. Yep.
And so, would you say is that an industry standard?
It is not an industry standard at all, not even close.
Yeah, and if you had to put a difference, percentage-wise, round figures, what is the difference that call makes? What is your conversion rate or contract acceptance rate when you don't call versus making that call?
It's hard to put an exact percentage on it, but I would say that the combination of the fully underwritten, which is rare already, and if it's a good realtor that's listing the house, they understand what that means.
Right.
They know that most lenders don't underwrite until they have a contract. So if we tell them it's fully underwritten, all conditions are cleared, we also offer a $5,000 guarantee on top of that. So we basically say, hey, we're so secure with where we are with this client and through underwriting, we're so confident in this family's ability to close that we will pay your seller an additional $5,000 on top of the earnest money that the client would put up.
Right.
If we do not close them for any reason related to the borrower's qualifications. So yeah, that phone call along with the fully underwritten, approval and the $5,000 guarantee. I would say we're probably getting 8 out of 10 offers accepted if we're to that point and can offer all of that.
Man.
Yeah.
And that's worth an eighth
Very
point
powerful.
rate. That's,
Right.
you know.
So whatever the internet lender's offering is
Yeah.
is really not as of much value, because if we hadn't have done all that, they likely wouldn't have got the contract on that house anyway.
Well, and
Absolutely.
you're talking about interest rate. Talk about rate secured and how that's played out over the last few months, and how that is from just the interest rate side and savings. How has rate secured been really helping your clients lately, and what is it?
So the package we have that we offer at no cost, no upfront cost to our customers, is called the Buyer's Edge. So we've talked about two parts of it already.
Right.
The first part of it is the pre-underwriting, so certified home buyer. Second part is the one we haven't talked about yet, which is rate secure. So that is the or what happens with that is when we get out of underwriting.
Right.
So we've been through underwriting, all conditions are cleared. We actually will lock in that customer's rate for 90 days. So they've got a 90-day window to shop for a house, not to close. They as long as they have a house under contract by the end, we can then lock it for an additional 30 days to have time to close. But yeah, so rates, as everyone knows, have been going up. They will probably still continue to go up. The Fed has future rate hikes planned already. So if we're locking that customer's rate up front, they can go out and shop knowing that their payment is not going to go up on them, that their payment's secured, that their approval is secured. We've heard a lot of horror stories in our industry about people that were, pre-approved with some lender and their rate wasn't locked, and they were pre-approved 3 months, 4 months ago, and all of a sudden their rate is 1.5, 2 points higher. And now they no longer even qualify for that house. But that lender doesn't call them and tell them that until they have a contract on a house. They get excited. They get an offer accepted. They go back to their lender, say, hey, we got a contract. And they find out, 30 minutes later, they get a call back that says, hey, sorry, at current rate, this house no longer, is fit your budget.
And that's
it's brutal.
crushing.
Brutal.
Yeah.
It's happening all across the country right now. So part one is fully underwritten approvals. Part two is locking in that rate for 90 days. You can go shop. And by the way, if rates go down during that 90-day window, we can lock lower. So if you end up getting a contract on day 60 and current market rates are lower, we don't have to take the higher capped rate. We get to take the market rate. So it's the lower of the two, essentially. And then the third part of that Buyer's Edge again was the $5,000 seller guarantee.
Right.
So pre-underwriting, locking that rate in for 90 days so you can shop, and then the $5,000 seller guarantee.
And this costs the borrower
powerful.
absolutely nothing.
$0.
$0.
Yep.
We love to see that.
Yeah.
Man.
So shifting it back to the borrower. So going back, and went all the way back to the first call, and you mentioned this briefly, but when you're pre-qualifying somebody going through the pre-approval, what are the three big criteria that you're looking at to get approved? Like what do I, Joe Debbie consumer, need to have? I mean, what's a good credit score? How much money do I need to have in the bank? I know how much money hits my bank account every month, but what are you qualifying on in that?
Great question. So this is very specific too. So we won't go all the way into all of this. This can
right. It can go.
Can be
there's a lot to it, but
more
just
information to where it gets more confusing than helpful. So we'll keep it high level. But basically, there's three levels, or three categories rather, not levels, but three categories of an approval. There's credit, which is credit scores, credit history, credit profile, bankruptcies, foreclosure, anything in the credit world it has to be reviewed. There's different credit score minimums for different programs. So currently you can go all the way down to 560 on a credit score. So you don't have to have 700, 800 credit to buy a house. In fact, we can get down to 560. So when we say review credit, we're not reviewing it to make sure that it's really high. We're just looking at it to make sure that what we have is going to fit into one of our programs.
Right.
So credit's first, income is second, and what we call debt to income. So that's as simple as it sounds. It's your income, your monthly income that we can use for underwriting, divided by your monthly debts not living expenses, just pure debt.
Mm-hmm.
If it shows up on your credit report as a monthly payment, that's what we're underwriting, and including the proposed new mortgage payment. Obviously, we're putting that into your debt to income ratio to figure out how much house you can afford. So budgeting is super important. So I don't always start with the maximum debt to income ratio and say, oh, you qualify for that much house. If we're really taking care of our clients, we're looking at their budget.
Right.
And usually their budget is less than they can qualify for. So we'll tell them if they've got a little more room, if their payment allows, their sweet spot budget payment allows for a $2,500 a month payment, and we can get them qualified, up to $3,000 a month. We'll let them know that and how much more house that equates to. But we also don't want to ever encourage or pressure them to spend more than they're comfortable, because at the end of the day, we want them to be happy in that house, have money left over for all the other expenses in life, and not be house poor. So debt to income is the second. So credit, debt to income. The third is assets. So some assets we're looking at for reserves, just for underwriting purposes. The other liquid assets we're looking at for the down payment.
Right.
And there are down payment assistance programs even out there today. So if you don't have much cash in the bank at this point, that doesn't mean you can't buy a house. There's some great programs for low down payment options, or even down payment assistance. Gifts from family members are also permissible by underwriting. So if you have a parent or grandparent, sibling, blood family member can give a gift to help with down payment or the closing cost. And then secured borrowed funds. So things like 401k loans, that's another common down payment. People have good income, great credit, good income, just haven't been in the job place very long and haven't saved up a big down payment yet. So the gifts and the down payment assistance and the 401k loans are the most common sources of down payment. So we start with all that. We basically say, Josh, let's talk through, credit, income, assets, and based on what we have to work with in those three categories, we'll basically steer you into the budget. So how much house you need to be looking for, what purchase price, and then work with you to make sure that fits your personal budget, and get you out there house hunting.
And then what kind of, and obviously this is a nuanced kind of question because every single borrower, every single situation is different. But what's if I'm a W-2 employee, what is my typical kind of documents and stuff? What am I submitting to the underwriter from 1,000-foot view?
Well, again, it's credit, income, and assets are the three categories. So credit, we pull a credit report that generally has everything we need, unless there's something we have to clean up or verify. So that one's pretty easy in terms of paperwork. You're usually not providing much. Income is usually verified with pay stubs and W-2s. Unless you're self-employed, then we'll get the 2 most recent years of tax returns and kind of do a self-employment analysis on the income there. And then for assets, bank statements, 401k statements, whatever assets we're using, we generally get 2 months of statements on all your liquid assets.
And you mentioned the certified homebuyer going into underwriting. From the time that I submit all of my documents, is that a long process? Is it a quick process? What does that look like time-wise?
From the time we get everything in, we're typically 1 to 2 business days to get through underwriting. So it's very quick.
Very nice.
Yeah, we have staffed up our underwriting department where they can handle not only the real live transactions, but also a healthy flow of pre-approval of underwrites.
So if we get on the phone and I'm wanting to buy a house and we have that initial conversation and we dive a little deeper and talk about credit, income, and assets, I submit my documents within a day and then it gets through underwriting. So from the course of a Monday to Friday, if I started early on Monday, within a week, I could be a certified homebuyer, ready to go looking at houses, making offers.
Absolutely. Yeah. I mean, it's quick. If we do have our initial consultation call on a Monday, you upload all the documents, which the document piece has gotten easier over the years because everything's electronic now anyway. Your pay stubs, you can usually go download off your ADP or your whatever payroll service your company uses. Your W-2s typically are available through your company HR department if you've been there for a couple of years, or in your tax folder, where you filed your taxes. Bank statements are all available online. So, I mean, most of my clients will get us everything we need within 24 to 48 hours on the long end. So if you're on the long end of that, and it's Wednesday before you get us everything, if we submit Wednesday, we still should be out of underwriting by Friday afternoon. So if we talk on a Monday, you can be fully underwritten and approved with a rate secured interest rate, locked rate, and a $5,000 guarantee in your back pocket to go shop that next Saturday.
Actually, I want to touch on something real quick. Sorry, Josh, I don't mean to interrupt, but like underwriting, very interesting piece. Is a 1 to 2 day turn time normal or industry standard?
Well, I would think it's probably on the quick side.
Mm-hmm.
I don't track every company out there, but
Right.
from what I hear on the street and from other referral partners, a lot of the realtors I work with will tell us that we're very fast. We're on the quicker end of that, because if you don't have enough underwriters and you've got a lot of pre-approvals coming in, you're going to be at a slower turn time
Right.
for all of those. So I would think it's on the very quick side. It couldn't be much faster. Let's put it that way. I mean, a 1 day approval is pretty dang fast.
That's pretty dang good.
Yeah.
Well, and what's the difference though between someone who is a Bank of America customer, they've banked with them forever, they go get their pre-approval done there. Explain the difference, kind of high level, of what underwriting looks like at a larger bank versus in a mortgage company.
Well, first of all, they don't pre-underwrite. So if you go to Bank of America or Chase, a lot of people assume that I've got money sitting at my bank, so I should go get my mortgage there, which is a reasonable assumption.
Right.
What they don't realize is that in the banking world, those are completely separate companies. Wells Fargo, that's where I started my career. They have Wells Fargo Bank and they have Wells Fargo Home Mortgage, and they're completely different companies altogether. And so, I mean, maybe they can access your bank statements because they're there, but that's not going to save you much time. If that's the only benefit is they can go get your bank statements for you and you not have to upload them, not a huge benefit. And so the big institutions are notorious for being slower.
Right.
At some points, really slow. It kind of depends on. Right now, interest rates are up and refinances have slowed down. So I think all of the underwriting turn times are probably a little quicker now than they were during like the peak last year during 2021. Sellers wouldn't accept offers from big banks because they knew big banks would take 2 months to close the loan.
Yeah.
If that, So, a lot of people assume that's because they have money there, they're going to get a better rate, or it's going to be an easier process, and that couldn't be further from the truth. I mean, the process is the same. Fannie Mae makes up all the rules for a residential home loan.
Right.
So even if you're going to Chase or Wells or Bank of America, it doesn't matter. They have to conform to the same rules as we do. And what I tell people is, look, banks do a lot of things. We all have a bank. They're great.
Oh, yeah.
But they're doing a lot of things. They're not just a mortgage lender. They're doing auto loans and credit cards and checking and savings and CDs and all the other products they offer. We do one thing. We do home mortgages. So we're able to focus our business on that product and that service and that client experience to make sure it's the best out there.
Now, you mentioned closing times and being able to close. Big banks taking 60 days and that kind of thing. So jumping from, say I get my house under contract, because you call, lay out the seller guarantee, talk to the listing agent. Then I go under contract. And as a home buyer, I went through this process. It's kind of like, okay, well, you're going to sign in about, in my case, it was a month. With us, it would definitely be probably faster than that. But what happens from the time I get under contract until the day that I close? What kind of work goes into that on the mortgage side?
Well, if you're fully underwritten with us already, there's not much left to do, honestly. That will get you some updated disclosures that are property specific. So we'll look up the actual property taxes on the property you're buying, replace the estimated tax number we had with the real one. You will get out and find an insurance company you want to do homeowners insurance with, get a quote from them so we can firm up the insurance cost. We need an appraisal. Appraisal is the document that values the property. So in most cases, appraisals are required, and that's something you don't have anything to do with. It's just something we order on the loan side. On your side of things, not the mortgage side, but on what your realtor is coaching you to be doing, is getting a home inspection. That's different from an appraisal. Appraisals, they do take pictures, they do go to the property, but they're more concerned with the value and the condition overall than they are small repair type items or even large repair type items. So an inspector would be the one to go out and crawl around under your house if it's pier and beam and get in the attic and, flushing toilets and making sure everything's working and in good shape and recommending repairs to anything that's not. So when you get a contract, you tell your lender, you tell us, send us a copy of it. You order inspection on your side. You'll generally meet with the inspector after he's finished, just kind of walk through and hear his feedback. And really, since we're done with underwriting, there's not much left to do. That's why we can close so quick. We get the appraisal in, usually in 5 to 7 days. And if we're trying to do a 2-week close, if it's a 10-day close, and we have the appraisal back on day 5 to 7, you're through the inspection period already. Any repairs were negotiated. And we're really moving out of underwriting toward closing at that point.
So then once I get to the closing day, I'm there. I get my signing arm ready to rock and roll. I sign a whole bunch of paperwork and sign all my documents. What kind of stuff am I signing when I look at this giant stack of papers and I feel like I'm signing my life away? Kind of walk through. I know that we obviously don't have time to walk through everything that you sign, but what kind of stuff am I signing there? And then do I walk out of there with the keys and I'm done until my first payment?
You might. So to answer your first question, I mean, the loan packet comes out to you several times during the process. There's right up front, when we do a pre-underwrite, you get a big packet electronically. You can DocuSign from us. It's typically at that point all very generic. It's just documentation or disclosures, rather, that we have to send out upon an application for a mortgage. So it can be everything from anti-discrimination type documents to U.S. Patriot Act to, what is title insurance, all kinds of stuff that really you're not completing those forms. It's just stuff we have to send to you, and you sign to acknowledge receipt. So you're getting stuff from the very first day you apply. Then when you get a contract in a home, there's another round that goes out that has more property-specific documents. And then on closing day, you've seen a lot of it already. You're re-signing a big part of the original package again at closing. It's just got the final closing date on it, final signatures. It's all the final stuff. We've gone to kind of a partial e-close now. So used to, you'd get there, when you bought your house, Josh, there's probably close to an inch of paper. It's probably 120 signatures. It was crazy,
and not just 8.5 by 11. It was like 2 feet long of paper. Like they made the paper bigger so that the stack was smaller.
That's right, legal size paper, fit more on it. But what we've done now is all that generic stuff that you've already seen a couple of times and DocuSigned a couple of times for us. That historically has always been at closing, where you had to actually wet sign it again, even though you've seen it 3 times. Now we're able to, the morning of closing, they send out an e-signable packet that has all that stuff again. So you can open your phone or open your computer and click through all that generic stuff that you don't want to have to. You can save your forearm for the important documents at that point. So if you've done it that way, then you get to closing, and there's really just the important stuff. We'll say, there's several title documents they'll explain to you that are kind of like our disclosures, but they're their disclosures, the title companies. So the most important documents are the deed of trust. That's the document that is filed and recorded to prove that you're the owner of the house. That if somebody came in and said, I own this house, you go to the title company and prove that they don't, and you do. And then the mortgage note is the final form or final document that proves out all the terms of the mortgage. It's got a lot of generic language in it, but it'll of course have your loan amount, your interest rate, your monthly payment, all that stuff on it. And so if you do the e-signing the morning of with all the generic stuff, it's really only about 10 or 15 signatures at closing. And most title company closers are really good at walking you through and explaining exactly what each document means.
Yeah, I've been to some closings, and you can tell the rock star title agents because they make the borrowers feel really at ease about everything that they're signing.
Yeah, that's right.
So-
You'll be really aware of what you're signing for the mortgage because
Yeah.
you've seen it a couple times. We've already explained that. They'll be the ones to explain their forms and the kind of the publicly recorded documents.
Now, after that, after I sign, when do I get the keys?
So the seller has to sign some stuff too. So typically on closing day, you'll sign at a scheduled time. The seller will come in and sign. It's not usually at the same time. Usually they'll pop in at a different time. Their stuff's pretty small. A seller doesn't sign many documents, so they're usually in and out. And then the entire packet is scanned in by the title company, sent to our closer at Churchill, who will review it, make sure everything was signed and executed properly. And then we give them permission to fund. So you're not waiting on wires from us. We always wire the title company sometimes the day before or at least the morning of your closing. So even if you sign late in the day, if you have a 4 o'clock signing, if we didn't send our wire till 4:30 after you'd signed, then you may not fund. The loan may not actually go through. That's the term we use for the loan going through is funding till the next morning. But since we send our wires early, even if you sign late in the day, once the sellers have signed, once you've signed, and then our closer reviews everything and says good to go, that's when the title company will reach back out to you and say, we just got funding approval. And at that moment, there's no turning back. You own the house, and it's yours.
So if it's set up where the seller comes in, signs, and then I come in after the seller, sign everything, we could sit at the title company, wait a little while, and then walk out of there with the keys. Is that right?
Absolutely. Yeah. Most of the time, it depends. If the seller's leasing back the house from you, the new owner, then you may not get the key that day. But if they already have moved out, usually the seller will move out, a day or two before closing, get it cleaned for you so it's ready for you to move in. Then yeah, typically you'll get the keys, or sometimes they'll even give you the keys before funding, just because they know you're not going to go break in and have a party before funding happens. And so typically you'll get the key either right then at funding. Your realtor typically will have the key already and just won't release the key to you, or they'll bring it by your house or whatever and give it to you. But yeah, so you can be closing and funding and having a little pizza party and lawn chairs in your living room that very afternoon.
And then after closing, after I get the keys, how long is it until I make my first payment?
Good question. So that's part of the fun part of the conversation we get to have is it's not as soon as you'd think. It's always the second month after closing, which helps a lot with overlapping rent, or if you have another property you're selling, overlapping mortgage payments. So it's always the second month after you close. So we're in June right now. So if you're signing closing anytime in the month of June, no payment on July 1st. First payment falls on August 1st. So you have the month of July with no mortgage payments. And the reason is because mortgage payments are made in arrears, which means backwards. So that August 1st payment is actually for the month, the interest for the month of July. So you're not behind. A lot of people think, well, if I don't have a payment that month, am I getting behind on interest, or is my escrow going to be behind? Things like that. It's not. Mortgage payments are always paid due the first of the month for the previous month of accrued interest that you accrued during that first month. Escrow accounts are funded at closing as well. The escrow account is your taxes and insurance being put aside to be paid on your behalf, and they collect for that month with no payments. So your escrow account doesn't fall behind either.
So what happens if you mentioned if I close in June, first payment August 1st? So we're here at the very end of June. If I don't close until July 1st, when is my first payment?
September 1st.
So I could push it a whole month back just by waiting a few days if I need to line it up with my lease ending or selling my current house.
You can. The only downside to that is that closing you pay what's called prepaid interest. So today is June 30th. If you're closing today, which I'm going to a closing right after this, they will only at closing they pay the month of interest. They pay the interest for the remaining days left in the month. That way, their first payment isn't bigger because it has a month and a half of interest or whatever in it. So if you close on the 15th of the month, for example, you pay the 15th through the end of the month at closing because you don't have a payment for that period of time. So if you say, well, I don't want a payment until September, I'm going to be real smart like Josh. Let's not close today on June 30. Let's close tomorrow on July 1st. That way I have 2 whole months without payments. That's true. However, we're now collecting the entire month of July interest, July 1st through July 31st at closing. So the number due at closing, that line item on your closing statement for prepaid interest just went from 1 day to 31 days. And so that comes out of your pocket at closing, which is similar to having a payment anyway, right?
Yeah.
So
it's kind of, do I want a higher closing cost or do I want to push this thing out? Which, goes into life situations like you mentioned. If my lease is ending by a certain day, you can line it up however you need.
There's no problem in closing on the first day of the month. It's not like that's a bad idea. It does give you August or the entire month of July with no payment. In August, no payment. September would be the first. But again, it increases what you're bringing to closing, which is similar to having a payment for that month anyway.
Yeah.
Short story, we're going to get our money one way or the other.
That's right. There'll be no gaps in interest
paid. There will be no gaps.
Yeah.
So after close, this is a question that I see come up a lot. People call in and go, "Hey, I haven't heard anything about where I'm supposed to make my payment, and it's been a week, even though we know it goes out to the very the next month." That gets into the conversation about servicing. So obviously, once you go through this process, and it can be a lot in a hurry, and then you're also going to be paying on this every month, and that involves servicing. So how long does that take typically? I'm sure there's nuance there until I get the email, letter, however it comes across, and how does it come across to set up my payments once my mortgage closes?
Yeah. Well, so let's talk about what servicing is first. So servicing is the name of the company that will be collecting your payment every month, and will be if you have an escrow account, they'll be maintaining your escrow account, making sure there's enough money in there, paying your taxes and insurance for you. So that's what servicing is. Some mortgage companies sell all their servicing immediately. It's a revenue stream for the lender. Others maintain and service some or all of their mortgages. Fannie Mae ultimately insures and owns the actual mortgage debt. So the servicer doesn't actually own your loan. They own the rights to the servicing of the loan. So Fannie Mae buys all whether you go to Wells Fargo or Chase or little mortgage mom and pop on the corner. If it's a conventional mortgage, Fannie Mae's buying it immediately after closing. Servicing, however, Fannie Mae doesn't service. So the lender that funds the loan then either retains it and services it themselves, or sells the servicing off. The terms of your loan can never, ever change. So nothing's changing other than the name of the institution at the top of the webpage where you go view and make your payments. So that's what servicing is. And Churchill currently services, I think, about 80% of our conventional mortgages. So there's a very good chance that your loan would stay with us for servicing. But even if it didn't, nothing would be any different. It would just be a different website you'd log into. So typically, minimum of 2 weeks prior to your first payment being due. So if it's an August 1st payment, by mid-July, early to mid-July, you'd be receiving a packet in the mail from us and an email from us as well, with the servicing instructions. So it would say, hey, congratulations on closing on your new house. We hope you're loving it. Here's the website for Churchill Servicing. You can set up an account. You can go in there and make auto payments where you don't even have to think about it. It just on the first of the month, it auto debits your mortgage. Or if you want to make extra principal payments anytime, all of those servicing features would be there on the site. If we're not keeping it, then what would happen is we would send you that same letter and email that would say that, we've sold your servicing to PennyMac, or one of the big servicing institutions, and they are going to be sending you a letter here shortly that says, with their instructions on how to get on their website and set up all the payments and everything. So typically 2 to 3 weeks before your first payment is when you'd receive one of those two notifications from us, and also if it's being sold, the new servicer. And you have a 15-day grace period. Mortgage regulations in all of America, doesn't matter what the lender is, you're not late on the mortgage. This is actually in your note, the document you signed at closing, until the 15th day after the first. So we call it a grace period. You have a 15-day grace period. So even if I've had clients call me on the first and say, Randy, we never got the letter, and they probably threw it away by accident. It happens. But we never got the letter. What do we do? It's due today. We don't want to be late. And I just say, calm down. You got 2 weeks. This is every month, not just your first payment, but every month. You could set your payment to go out on the 10th of every month if you wanted. It's a 10-day grace period, a 15-day grace period. So there's no reason to panic. If you get around to the first and that payment's due, you're still fine. There's still 2 weeks to get that payment in.
So now fast forward a couple years go by, property values move, you heard all that stuff, and you get into hearing people say, my payment went up by $100. And you said servicing, they can't change the terms of your loan. So why does that happen? If I'm a first-time home buyer and I'm expecting to pay X every single month and I escrow, how do people have their payments go up on them?
Well, your principal and interest payment, if you did a fixed-rate mortgage, which is typically 99.999% of the loans we do at Churchill, with very few ARMs. In my 14 years here, we've done a handful probably. So if it's a fixed rate loan, your principal and interest payment can never change. Will never change. Will always be, if it's $1,400 on day one, it'll be $1,400 on
month
payment 360. Yeah. Right. So what can change are your property taxes and your homeowner's insurance. So if the payment is moving up or down, it's not because the principal and interest changed, it's because your taxes or your insurance went up or down. Lately, it's been up, right? It's like payments rarely go down. So what happens is every spring with property taxes, every spring, your county sends out a letter that you get a copy of, but it also goes to your servicer, and it says, hey, here's your new taxes due in December. Your tax value, your new property tax amount. And the escrow company will then have to adjust your mortgage payment to collect for the first 3 months of the year that they weren't collecting enough, because they don't get that letter usually until April. So they're back collecting a little bit so that there's not a shortage. Mm-hmm. And then they're raising your payment starting in May through the end of the year so that there's enough money in that escrow account to pay your taxes. Same thing with insurance. If your insurance goes up, they have to adjust the escrow account to make sure there's enough in there. So you would do the same if you were self-escrow. Escrow is just a fancy word for holding funds on the side for your benefit. That's what title companies do, on a purchase transaction. So escrow account is just a separate account that the servicer sets up to hold your money to pay your taxes and insurance. So even if you self-escrow, meaning you did it yourself, you'd still have to be watching your taxes and your insurance and saving more money every month to account for the increase in your property taxes or insurance. So some people get upset when they get those letters because they don't understand, but if it's explained well to them, if the customer service person they get on the phone at that point, if their servicer explains it, then it generally makes sense, and there's no way to get around it, unfortunately. It just means your taxes went up. Property taxes have historically been significantly below market value in Texas. So if you buy a $500,000 house, it's probably on the tax rolls at $350 or $400, and that's good for you. It means your taxes are going to be a little lower. But if as they continue to increase them each year, your taxes are going to go up. So it's just something to be prepared for, and you want to have a little cushion in your budget, knowing that, hey, they've got us undervalued right now. We're at $350, we're paying $500. Next year, they're going to see that we paid $500, and they're going to raise our taxes up pretty substantially. And so that's a conversation we have with all of our clients up front is, yes, you can afford the payment now based on the taxes that are technically too low based on an old value, but you need to be prepared with the monthly family budget to take on $100 or $200 or $300 increase in taxes next year when they reassess. Again, push button mortgage, big banks are not going to explain any of that to you. This is all part of the stuff that working with a true mortgage expert is going to benefit you outside of maybe that eighth better rate. If people get so hyper focused on rate, but there's so much that goes into home ownership that if you got a good mortgage advisor or the counselor that's experienced and understands all this, you will be more prepared down the road, and you'll forget what the rate was. It won't even matter.
Well, Randy, I thank you, because like you said, I mean, it's part of the experience. I think that's what we believe in the most here at Churchill, and thank you for diving into that, because I think it truly does display the difference we try to make in our customers' lives. But not only that, but the difference we make, on all sides of our business and the people we work with. So I appreciate you a lot. Thank you for sharing some wisdom and spending some time with us. Josh, I'll let you lead us out of here.
Yeah, I think that's it. Hopefully that helps people that are going through the process and buying a house, understand the full picture, the full timeline. And thanks for sharing all that. And hope it was beneficial. Until next time.
Until next time.
Thank you, guys. Good being with you.